My name is Mary Pearl Okare Ado, and I'm the course tutor for corporate financial analysis. In this session, we'll be discussing the effects of leverage and working capital ratios. So, by the end of the session, you should be able to distinguish between operating leverage and financial leverage, explain the effects of leverage on return on equity, and also compute the various working capital ratios and relate them to the operations of businesses or firms. In this session, we'll discuss financial leverage and operating leverage and how they impact return on equity, and also examine the effects of leverage. We'll also discuss working capital ratios. Now, the term leverage is used to describe the ability of firms to use fixed cost assets or funds to magnify the returns to its shareholders. Now, leverage is simply your ability to make the maximum advantage out of something. So, for example, when it comes to financial leverage, when you use borrowed funds, you're able to use borrowed funds such that you make more returns on those funds you borrowed that exceeds the interest you have to pay on those funds, then you have or you're enjoying leverage. Now, there are two types of leverage: one that arises from financing activities, that has to do with the capital structure of the firm, especially with the example I just made, where you have to use borrowed funds or debt, then that is termed as financial leverage. And another type that's amounts from operating activities of firms, where you have to use a fixed cost assets, for example, like a plant or a machinery or an equipment that will you use in generating your primary revenue activities. Yes, so that is the operating leverage. So operating leverage has to do with the operating activities of the firm, and these are the core or the revenue generating activities of the firm, those activities that the firm generates its revenue from. So if in cases when the firm has operating leverage, they are probably using a fixed cost asset or an asset on which they have to incur fixed costs, which could be either a plant, a machinery, or an equipment. Now, the operating leverage works such that regardless of the units the company sells, the company is going to incur that same amount of fixed cost. Even if the company decides not to sell at all, the company will still incur that fixed cost. So the ability of the firm to increase its earnings using that fixed cost is dependent on its ability to make more sales in or yes make more sales or sell a lot of quantities of its goods in order to leverage on this effect, because whether you sell 5,000 units of your products or your goods, you'd still incur thanks to this fixed cost. When you sell 100,000 units, you still incur thanks to this fixed cost. When you sell 1 million units of goods, you still incur the same fixed cost. So your ability to increase or maximize the advantage you have or sell more goods is what we term as operating leverage, because the same amount of cost would be incurred regardless of the units you sell. Now, this is simply the tendency of operating profits or earnings before interest and taxes to vary disproportionately with sales. Like we said, the operating cost of the firm can fall either within the fixed cost, the variable cost, and the semi-variable cost. The fixed cost, your ability to leverage on the fixed cost is where you get your leverage from. And so the operating leverage is shown mathematically by, or is equated to, the contribution divided by earnings before interest and taxes, or simply contribution divided by operating profit, where contribution, which we will denote by C, is equal to your selling price or your sales revenue minus your variable cost, and that would be your operating leverage. Now, when it comes to finance or financial leverage. It's the ability of the firm to use its fixed financial charges to magnify the effects of changes in earnings before interest and taxes on the earnings per share of the company. So we know when you check the capital structure of most firms, they either employ only equity or equity and debt. Now the debt is the borrowed funds, and firms have to, or they incur interest on these funds. Now the ability of you to use the funds in such a way that you get more returns on those funds that exceeds the interest you have to pay on them. That's what financial leverage is about. So it indicates the use of earnings in making payments for fixed interest and fixed dividend bearing securities. Now financial leverage is equated to the earnings before interest and taxes divided by the earnings before taxes. So there's combination of both financial leverage and operating leverage is what gives you the combined leverage. And that is a measure of the percentage change in earnings per share due to percentage change in sales. So like I mentioned earlier, when it comes to operating leverage, it has to be do with you maximizing or making the most out of your fixed cost. And then when it comes to financial leverage, making the most out of financial charges you have to pay or interest payments. Now, your ability to use these two to the maximum such that you can increase your sales and get more profit or earnings for the firm is what combined leverage is about. So it measures the total risk of the firm. So combined leverage is equated to operating leverage times financial leverage, or in other words, contributions divided by earnings before interest and taxes multiplied by earnings before interest and taxes over earnings before taxes. And to simplify it, combined leverage is simply your contribution divided by your earnings before taxes. So your contribution I mentioned earlier is the sales revenue minus your variable cost divided by your earnings before taxes, and that gives you your combined leverage. There are two drivers that are used to describe the operating profitability of firms, and these are the profit margin and the assets turnover. So profit margin is simply the ratio that is used to measure the relationship between profit and sales, and they can be broken down into two components: your sales profit margin and other items profit margin. So when it comes to the profit margin, it's simply the difference between your gross margin and your expenses. So gross margin ratio minus your expenses ratio would give you the sales profit margin. And other items profit margin are certain items which have impact on profit. Usually these items are not related to the day-to-day operations of the firm. For example, special items divided by net sales. Also, you can have other items profit margin like the other gains or losses divided by net sales, or your subsidiary income divided by net sales. When it comes to asset turnover, it's also known as the investment turnover ratio, and that indicates the relationship between your sales and other assets or investments of the firm. So it's used to measure the efficiency of a firm in making the most out of the assets the company has. So the assets may be fixed assets or non-current assets, and we can break those two down into fixed assets turnover and working capital turnover ratio. So the fixed assets turnover has to do with tangible assets like the plants and machinery, equipment, furniture and fittings, land and buildings, those fixed assets. And the working capital turnover ratio has to do with current assets. So fixed asset turnover indicates the extent to which investment in fixed assets contributes towards sale. So if the company purchases a new plant or equipment, how is that plant or that investment in the plant or the equipment or that machine contributing towards the sale of the firm or the sales revenue of the firm? So So this ratio can be subdivided into turnover for each item of non-current assets. So you can have your your plant or machinery divided by your investment, or your furniture and fittings, or land and buildings, or each specific item of non-current assets. When it comes to working capital turnover ratio, it simply implies the extent of working capital turnover in achieving, or the amount of working capital that is used to achieve the sales of the firm. So the working capital turnover ratio is the ratio of net sales to working capital. And when it comes to working capital, that is the difference between current assets and current liabilities. Now we have debt turnover ratio, and debtors is one of the current assets of the firm. So they are usually called trade receivables or customers of the firm, and they are people the firm makes sales to on credit. So this ratio measures whether the amount of resources that is tied up in debtors is reasonable, and whether the company has sufficient, or whether the company has been sufficient in converting its debtors into cash. In other words, how fast is the company able to retrieve the money, or money it has locked up in trade receivables. So if the company makes sales to customers on credit, how how well is the company able to make sure that customers pay back those goods they have taken on credit? And we have the average collection period, which measures the liquidity of firms' debtors, and that is the average collection period. So how long does it take, or how many days does it take for debtors to pay their debts, or for trade receivables to settle their debts owed to the company? We also have creditors turnover ratio, that indicates the speed at which the company makes payments for credit purchases to its creditors. So the credit turnover ratio is simply credit purchases divided by average creditors. And there's also the creditors payment period, that is used to measure how long, or the average time that it takes the company to pay for goods and services that the company has purchased on credit. There's also the inventory turnover ratio, that indicates the number of times inventory is replaced during the year. So this ratio is used to measure how effective investment in inventory is. So how efficiently is inventory being used? And in other words, how many times does it take for inventory to be replaced? So the inventory turnover ratio is simply the cost of goods sold divided by the average inventory. And the average inventory is the opening inventory plus the closing inventory divided by 2. We also have the raw material turnover, that's the cost of raw materials used divided by the average raw material inventory. The work in progress turnover is also the cost of goods manufactured divided by the average work in progress. So in this session, we discussed the effects of operating leverage and financial leverage on the operations of firms, and we made mention that operating leverage stems out from the operating activities of the firm. That has to do with when the firm employs fixed cost assets, and financial leverage is in relation to the financial activities relating to the capital structure of the firm, when the firm employs debt on which it has to pay interest, or it incurs fixed charges or financial charges. We also computed and interpreted various working capital ratios in this session. Thank you.